Starting with the crude oil prices first, how would you read the turn of events where we have seen such a sharp correction come in for the crude oil prices, and what's your sense going forward?
Hi, Manisha. Yes, it's been a very big move of late. I think the two things that have changed really over the last month. Number one, commodity markets in general, and specifically crude oil, have become very macro-driven, and the weakness in global equity markets has translated into a wide risk-off sentiment across risky assets, and crude has been one of the markets that has been sold as a function of that. On the fundamental side, the only thing that's really changed over the last few months of late has been some concern about the demand outlook for crude oil. Previously, people have been very much focused on the supply side and the bottlenecks that people have been talking about on the shale side and the issues with the Iranian sanctions, and prices have been very supported because of that. So the weakness now is a function of these two nascent but emerging dynamics, and our view is that we move higher from here. Much of this weakness is macro-driven, as I said, and we see crude, Brent specifically, up to about $82, $83 for Q4 of this year.
All right. Since you are expecting the crude oil prices to come back to 80 and plus kind of levels, what is the range that you're working with for rest of 2018 and for much of 2019 as well?
Well, the interesting thing is that our risk outlook is particularly interesting. We have about a 20% probability that we could move as much as $15 higher from where we are now. And that's really a function of how the market takes the implementation of the Iranian sanctions that are starting in early November. And if there's any extra compliance to that, we expect about 1.7 million barrels to be lost. But anything more than that will be taken very bullishly. Concerns about whether OPEC, specifically Saudi, can make up spare capacity. There's been a lot of concern about that. And then, of course, any worsening of the supply outlook from the US, where previously we'd always been in an environment where shale oil was always there to make up any extra supply as needed and put a cap on prices. Now we've been in a period where we actually can't get the shale oil out of the Permian Basin because of bottlenecks in pipelines. They're due to be completed in the second half of 2019. So if we get any worsening of that situation, and if we get these risk factors converging, we could see a short-term spike, $15 higher up into the end of this year and beginning of next year.
Mark, one thing that really seems to have turned around yet again, and that really comes in from the precious metal prices, where gold is trading at a 3-month highs in the global markets. Are you advising accumulation for that now?
Well, gold has been particularly interesting because certainly the move up recently has been very significant. It's been about 5–6% since the August lows, about 4% month to date. A large proportion of that has been short covering. We had about $5 billion of shorts coming out of the market last week. And in fact, last week was the greatest in terms of futures contracts amount of short covering ever in the history of the market. So that's interesting for one, but it's also quite interesting with respect to how we move forward, because it means that we still have extra capacity on the long side for long speculators to add length. And we see gold higher between now and the end of the year, a little bit up to 1,250, a little bit higher in January up to 1,275. But we really need to see how the safe haven appeal that's clearly taking hold at the moment, how persistent that is, and how people accumulate also the ETF holdings. We've had about 1 million ounces of that over the last 2 or 3 weeks. So far the signs are good. It certainly stands in very stark contrast to how gold behaved in February, when we had a similar sell-off in equity markets and gold fell 2%. So this particular sell-off, this particular weakness seems to have been translated into a much more concrete, solid, safe haven demand for gold.